On May 7, 2025, India launched Operation Sindoor. This operation targeted terror camps located in Pakistan and Pakistan-occupied Kashmir. The operation was a direct response to the horrific Pahalgam attack, which claimed innocent lives and shook the region. India's approach was firm, yet calculated. The operation focused solely on the terror infrastructure, avoiding any collateral damage. Civilian areas, economic hubs, and military installations were not targeted. This demonstrated India's commitment to a measured and restrained response, even in the face of provocation. The international community reacted to Operation Sindoor with a mixture of apprehension and understanding. The United States, while not surprised by the escalation, emphasized the need for accountability for the Pahalgam attack. Israel stood by India, recognizing its right to self-defense against terrorism. However, the Organization of Islamic Cooperation criticized India's actions, accusing it of making baseless accusations against Pakistan. Turkey, a close ally of Pakistan, expressed concern over the potential for further escalation. The situation on the ground remains tense but contained. Both India and Pakistan have maintained a military presence along the line of control. However, neither side has shown an inclination towards a full-blown conflict. The international community has called for restraint and dialogue to de-escalate the situation. The coming days and weeks will be crucial in determining whether this latest episode in the Indo-Pak conflict can be resolved peacefully. The Pahalgam attack and India's subsequent response through Operation Sindoor are grim reminders of the volatile security situation in South Asia. The incident underscores the persistent threat of terrorism and the challenges it poses to regional stability. It also highlights the complex geopolitical dynamics at play in the region. The Indian stock market has a history of resilience, even in the face of geopolitical turmoil. Past conflicts with Pakistan have tested the market's mettle, but it has consistently bounced back. Let's delve into specific examples to understand this phenomenon better. The Kargil War in 1999, while a time of national anxiety, saw the Nifty index gain an impressive 35.6% by the war's end. This surge came after an initial jump of 7%, demonstrating the market's ability to absorb shocks and recover swiftly. The 2001 Parliament attack, a direct assault on Indian democracy, did trigger a knee-jerk reaction in the market, with the Nifty declining by 4%. However, this dip was short-lived, and the market soon regained its footing. Similarly, the horrific 26/11 Mumbai attacks in 2008, which shook the nation to its core, saw the Nifty increase by 3.8%. This resilience underscores the fact that while geopolitical events can trigger volatility, they don't necessarily dictate long-term market trends. Even more recent events like the 2016 Uri attack and the subsequent surgical strikes resulted in a marginal 0.4% decline in the Nifty. This minimal impact suggests that the market has become increasingly immune to such events over time. The Pulwama attack and the Balakot airstrike in 2019, which brought India and Pakistan to the brink of war, saw the Nifty initially decline by 0.6%. However, by the end of the operations, the index had gained 0.4%, reinforcing the market's ability to weather geopolitical storms. This historical context is crucial for investors. It highlights that while geopolitical tensions can trigger short-term volatility, they rarely derail the India growth story. The market has consistently demonstrated its ability to absorb shocks and emerge stronger. This inherent resilience should give investors confidence, encouraging them to stay invested and ride out temporary storms. The immediate aftermath of Operation Sindoor has seen a relatively muted response from the Indian stock market. While there have been fluctuations, no significant downturn has occurred. This muted response can be attributed to several factors. Firstly, the focused and restrained nature of Operation Sindoor has instilled confidence in the market. The fact that the operation specifically targeted terror camps, avoiding civilian and economic centers, has reassured investors that a wider conflict is unlikely. Secondly, the Indian economy is far more resilient today than it was during previous conflicts. Structural reforms, a robust domestic market, and a diversified economy have created a buffer against external shocks. This economic strength provides a solid foundation for market stability, even amidst geopolitical uncertainty. Expert predictions further bolster this view. Analysts believe that the market is unlikely to experience a sharp downside due to Operation Sindoor. However, it's crucial to acknowledge that the situation is fluid. Market sentiment can shift rapidly based on developments on the ground and the broader geopolitical climate. The potential for escalation, though currently low, cannot be entirely ruled out. Therefore, investors should remain vigilant and stay informed about any developments that could impact market sentiment. Despite the inherent uncertainties, the initial market reaction to Operation Sindoor points towards a new era of resilience. The Indian stock market, backed by a strong economy and a measured government response, appears better equipped than ever to withstand geopolitical shocks. This resilience bodes well for long-term investors who understand that short-term volatility is an inherent part of market dynamics. The impact of geopolitical tensions on cryptocurrencies is a relatively uncharted territory. Unlike traditional markets, cryptocurrencies operate in a decentralized and globalized digital realm, seemingly detached from traditional geopolitical influences. However, this does not make them entirely immune to real-world events. The interconnectedness of global financial markets means that any significant geopolitical event can trigger volatility across all asset classes, including cryptocurrencies. In the context of the current Indo-Pak situation, it's plausible that cryptocurrencies might experience heightened volatility in the short term. Investors, grappling with uncertainty, might seek safe haven assets like gold or US dollars, potentially leading to a sell-off in riskier assets, including cryptocurrencies. However, this knee-jerk reaction is unlikely to translate into a long-term trend. The decentralized nature of cryptocurrencies makes them less susceptible to manipulation by individual governments or central banks. This inherent characteristic could make them attractive to investors seeking to diversify their portfolios and hedge against geopolitical risks. Furthermore, as the global adoption of cryptocurrencies continues to rise, their correlation with traditional markets might weaken. This decoupling could further insulate them from the direct impact of geopolitical events. The evolving landscape of cryptocurrencies makes it challenging to predict their exact trajectory in response to geopolitical tensions. While short-term volatility is possible, their decentralized nature, growing adoption, and potential as a hedge against traditional assets could make them an attractive option for investors navigating uncertain times. However, it's paramount for investors to approach cryptocurrencies with caution, acknowledging their inherent volatility and the nascent stage of their regulatory landscape.